Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is the earnings special edition where our focus is on five-star business finance. The NBFC, which has reported its Q4 numbers, we have seen that the NBFC has recorded a 40% growth in the profit after tax in the March quarter to 236 crores. The disbursements for the company have grown by 20% at 1336 crores. Even the assets under management have seen a very strong growth of 39% on a year-on-year basis. Now, to discuss some more insights from the quarterly earnings and the outlook going forward, I'm now joined by the top management of the company. Srikanth Gopalakrishnan joins in. He is the CFO of Five Star Business Finance. Warm welcome to you, sir, on Business Today Television. It's great to have you with us. Congratulations on this strong set of numbers that you've delivered for Q4. First up, if you could help us understand, how have you assessed the numbers? Has it met your own expectations? And of course, what's really worked for you in this quarter? And do you see sustainability?
Thank you, Sakshi, and thanks for having us on this show. Definitely, Q4 was a great quarter for us. Like every other Q4, typically amongst the 4 quarters in a year, the last quarter tends to be the best because you're putting up your best show for the markets and everybody. Though today, every quarter, we present ourselves in front of the market, but typically Q4 tends to be very good. This is also the second normalized year after the two waves of COVID. And in both these years, we have grown about 37% and 38.9% respectively on our portfolio. What we are seeing is a strong demand on the field. Just to give you a little bit of a perspective about Five Star, we operate in the underserved market where people's only other alternatives towards funding are largely from friends, families, and unorganized institutions. So we actually go there and displace these money lenders. We provide loans for business purposes, housing purposes, and mortgage purposes. And these are essentially customers who are in the service-oriented businesses. So which means they're probably the last to get impacted and first to bounce back. And nothing better could have indicated this stance than the two waves of COVID. After the two waves of COVID are behind us, today we are seeing a very strong demand on the field. Like you rightly said, we have done a 1300 plus crores of disbursals in this quarter. Our overall disbursal for this year is almost close to 5,000 crores. So for us, I think it's been a great quarter, not just in terms of loan growth and disbursals. What is also very heartening is that the asset quality is maintained at almost similar levels as of last year or the last quarter. Despite operating in seemingly vulnerable segments, we have a 90 plus or a NPA, non-performing assets ratio of 1.38% for this quarter. So and this has translated into a very strong profitability for the quarter at about 236 crores and for the full year at about 836 crores. So yeah, we're very happy with the performance and with the kind of infrastructure, both physical and human infrastructure that we have. We are very confident of delivering, consistently good performances in the years to come.
Okay. On the asset quality, like you mentioned, do you still have room to further see an improvement in FY25, and where would you see comfortable levels around?
So I think it may be a little, too much to expect us to keep improving our asset quality from here on. In fact, the more we reach a steady state scenario, we will probably see some, slight slippages that may come through in the asset quality. But given that we're operating at an yield of around 23-24% and extremely profitable, a few basis points of increase that way is not going to be very material. In fact, in the past, we had guided the market on 1.5 to 1.75% of steady state NPA. What I would also like to reiterate is that these are computed as per the new norms. So while if you look at a point of time, a customer who probably would be less than 90 days, but just because he had touched 90 plus at some point of time in the past, this circular became effective in November of 2022. From there, you're required to keep treating that customer as an NPA till he becomes current. So because of that, there will be a little bit of the numbers that you are seeing. But I would also say that if you look at our net NPA, while our gross is about 1.38%, our net NPA is just about 63 basis points because we are also maintaining a very good provision on this, around 54-55% of provision. So we'll continue to keep maintaining good provisions so that you don't really you're not staring at any uncertain losses in the years to come. So I would not guide you for any great benefits to come in beyond this, but I think we'll probably stay around similar levels going forward.
Okay, and on the disbursals as well, strong growth like you pointed out for FY25. What is the outlook that you have?
See, disbursals and loan growth, very clearly, we are expecting a growth of, we have delivered 2 years of 30 plus growth. We don't see any challenge in delivering a 30 plus percentage growth for FY25 and the years thereafter as well. There is a very good demand available there. And like I said, we have the infrastructure to cater to this demand. So, for the full year, you will probably see a portfolio growth of about 30 plus percentage. And obviously, disbursals, again, we are probably seeing 20-25% kind of a growth that will come in. So, all points to a strong year to come.
And which will be the driving forces here in terms of demand? Since you said that you have various verticals like mortgage, housing. So, where are you seeing the maximum demand emerge from for FY25?
See, for us, the portfolio, if you look at it, and this has sort of remained largely the trend in the last many years, we predominantly give loans for business purposes. So 50 to 60% of our loans are given for business purposes. About 15-20% goes for asset creation or housing. It could be construction, renovation, repairs, extensions. And about 20-25% goes for other events in the family like marriage, education, and all that. I think this trend is largely going to remain as it has remained for the last many years. The growth levers, what we have also highlighted in our earnings call presentation, primarily comes in from two factors. One is increase in branch count. This year was a little bit of a uptick given that we added about 147 branches, but in a consistent scenario, I think 80 to 100 branches addition in a year is definitely doable, which means you're also going to add more feet on street. So that's the first and the biggest lever of growth that we will probably see. The second is a little bit of an increase in the average ticket size. We have been operating around 3.5 lakhs average ticket size for many years. It dropped significantly during COVID. We are back to that number as we speak. But I think going forward, we will also do some bit of inflationary increases on the average ticket size. So predominantly, I think will be led by business loans and through branch expansions, which will be a lot more granular expansion, and some bit of growth coming from average ticket size.
Right. So, is any part of it also unsecured as well? Why I ask you this is because in the last 6 months or there has been a huge concern from the RBI in this entire space. So, just wanted to get that clarification from you, sir.
So, very categorically, we don't have a single rupee of loan that we have given on an unsecured basis. Okay. Every loan that we give is secured and secured by one of the strongest assets. These are secured by the land and building. And in 95% of these cases, this is the self-occupied residential property where the borrower and his families are living. In fact, one of the reasons that we have been able to maintain a very strong asset quality, in our view, is because of the strong collateral. So while we do underwrite him on the basis of his cash flows, but whenever there is a downturn, like we saw during the demonetization, during the 2 waves of COVID and all that, the property helps the borrower prioritize our loan over any other loan. So very clearly, we believe, and our stand has been indicated over the last many years, is that this is one of the strongest emotionally attached collateral for the borrower. And you will never see an intentional default in this. If there is a default, it would largely come because of some issues in the cash flows, deterioration in the living conditions of the borrowers. But we don't, as an institution, we don't believe in lending unsecured. And today, like I said, our collaterals are probably one of the strongest in the industry.
Okay. So a little bit on the NIMs front as well. Where are you at currently and how do you see the band growing in FY25?
Yeah. So I think before touching on the NIMs, I'll just touch on one related aspect, which is the cost of funds, which has a direct bearing on the NIMs. One of the other important facets that we have also been able to see in the last 1-2 years is a consistently dropping cost of funds on our incremental debt. So despite markets being very different, we all know that not the last year, but the year before, the repo rate went up by north of 200 basis points. But despite all of that, we have been able to maintain our incremental cost at around 950, 960, 970 levels. And this is also reflected in our book, where the book cost of funds is actually dropped from about 10.1 to 9.7 for the year. And that translates into both spreads and NIMs. Today, the NIMs are a little elevated because of higher capital. Our capital adequacy is north of 50%, where RBI mandates you to maintain 15%. So I think with the leverage coming in, so we have not raised any capital in the last about 2-3 years. Our IPO was only an offer for sale. We don't intend to raise any equity capital as we go along. But with the leverage kicking up, you will see moderation in NIMs that will come through. I think in a steady state, we are looking at operating NIMs around 15 to 16%. But then this will also have a very direct impact on the return on equity. In fact, for the first time, we have seen our ROEs going beyond 18% for the quarter. For the full year, it's about 17.6%. You will see ROEs inching up in a steady state, towards 20% levels. NIMs dropping, ROAs dropping, but you'll see an uptick in the ROE, and that's that's the most important metric that people out there are wanting to look at. People who have invested in the company and very confident of delivering strong returns to the shareholders.
Okay, ROE is going to be something that we need to continue to monitor, as that will be a driving force for you. On the assets under management as well, again, you have seen a very strong growth. About 9,600 odd crore rupees is where you are at currently. Your estimate, I believe, for FY25 was somewhere to the tune of 12,500 odd crore rupees. Is that doable? Are you looking to revise it upwards?
First question, is that doable? Definitely, we don't see any challenge, reaching a 30% or north of 30% kind of a growth. Very clearly, like I said, demand is there. We have the execution ability to go out there and satisfy the demand of these customers. So we don't see any issue from a demand or an execution perspective. See, at this point of time, we are not looking at revising our growth guidance upward because of primarily, the entire macroeconomic environment and the regulator wanting NBFCs and banks, not just us, but across the large NBFCs, the banks, and every company out there in the financial services domain. The regulator has been cautioning them to be a little more moderate in their growth. So at this point of time, we will continue to keep our guidance of 30+% for the next financial as well. If there is a positive surprise that comes through, if the situations improve beyond our expectations or beyond the expectations of the regulators, I think pushing this up is not going to be a challenge for us, given the execution engine that we have. But at this point of time, given macroeconomic conditions, nothing to do with the company. The company is in a very strong position, but given the overall conditions in the economy, we would prefer to stay at around 30 plus kind of a growth that we've been delivering for the last 2 years.
Okay, but you're already at nearly that 10,000 odd crore rupees mark. In the future, how soon do you see that 20,000 mark or the doubling of this figure really coming in for you?
So our belief, Sakshi, is that in the next 3 years, we should be a 20,000 plus crore kind of a company, which means roughly a CAGR of at about 28 to 30% is what we are looking at. So internal target for us is 20,000 crores plus by FY27. Fingers crossed at this point of time. We are confident, but hopefully all the omens need to align for us to achieve this number.
Okay, well, all the very best to you, sir, for that, and thank you so much for speaking to us and sharing all these insights from these quarterly earnings. Again, congratulations and all the very best for the upcoming quarters. Hope to catch up very soon again to understand more about the business and the growth going forward. Truly, thank you so much.
Thank you, Sakshi. Yeah, thanks.
All right, with that, viewers, we will wrap up this very special conversation with 5-Star Business Finance, the company now aiming to double its assets under management over the next 3 years by FY27 at a 20,000 odd crore rupees, right now at 9,600 odd crore rupees, the big headline coming in your way, and the company is very positive and optimistic about the growth going forward too. With that, we wrap up, but do stay tuned on to Business Today Television as we continue to get you all the insights from the world of business and stock markets, and of course exciting conversations and shows to follow. Do not miss the 12 p.m. show when we will get you your stock queries answered by top market experts on Daily Calls.